Insurance companies borrow your money first, and the interest they pay you? Negative, not even zero. Your money goes to Wall Street and grows many times over for 30 years. But when it finally comes back to you, inflation has already wiped out most of its value. They invest your money for decades, keep the gains, and return dollars whose purchasing power has already melted away. In short, insurers borrow from you at negative interest rates and invest on a scale so massive it's nearly half the size of all bank deposits in the United States. So what kind of magic are they using? Today, we're breaking down the shocking system that lets insurance companies make money off you. Insurance companies operate very much like casinos. Imagine this. You know your friend well, and you promise to protect his family. He pays you $10,000 today, and if he dies within 30 years, you'll pay his family $100,000. It feels like a gamble, right? But if you repeat this, not with one friend, but with 1 million people or 10 million people, it stops being gambling and becomes a predictable business model. One person's future is unknown, but the probability of 1 million people dying in the next decade is almost perfectly predictable. That's the power of statistics and the law of large numbers. Insurance companies hire mathematicians, actuaries, and now even AI to calculate these probabilities like a casino calculates its odds. Age, gender, occupation, zip code, medical history, family history, lifestyle, every variable becomes a number. And based on that, they set your premium or deny your application entirely. If you work a dangerous job or have health issues, you pay 50% more, or you may not be allowed to enroll at all. So ironically, healthy people who least need insurance get it easily, and people who actually need it often can't. Individually, you might profit from insurance, but across 1 million people, insurance companies never sell a losing product. If this was the whole story, insurance companies would still be rich. But not this rich. The real money comes from investing the float. Every kid has imagined, if everyone gave me $1, I'd be a millionaire. Insurance companies actually live that dream. People hand them billions today in exchange for a promise decades later. Insurers take that money and invest it in stocks, bonds, real estate, and more. When the time comes to pay claims, they simply pay you from the original premium and keep all the investment gains. In financial terms, your 50-page policy basically says, we'll take your money today, invest it for 30 years, and even if we make $2 million off it, we will only give you the $100,000 we promised. Adjusted for inflation, that $100,000 won't be worth much. But that's your problem. That's the system. This strategy is so powerful that Warren Buffett built his empire on it. He realized early that insurance float is free, interestless leverage, money he can invest for decades. So he used float to buy Coca-Cola, Amex, Heinz. Boring companies that rarely crash and eventually go up because float costs nothing. Buffett essentially invested with massive leverage and compounded Berkshire Hathaway into a giant. Your money may disappear in the stock market when you invest it emotionally, but when that same money becomes float in Buffett's hands, he compounds it for decades. Then there are the contracts. Insurance policies are written by legal experts, and each line in the fine print can become a reason to delay or deny payment, because insurers don't pay claims immediately if they don't have to. Their float earns money the longer they delay. That's why many insurers have earned the reputation: delay, deny, defend. Delay payments, deny claims when possible, and defend themselves in court until the customer gives up, all while the float keeps making money. Early cancellation is also extremely profitable for them. Insurance companies are stable. They survive recessions. Individuals don't. People lose jobs or face emergencies, and the first thing they do is cancel their policy to get cash. But cancellation refunds, often less than half of what they paid. Why? Because insurers load the first 2 to 3 years with expenses, paying sales commissions and internal costs up front. By year 3, when most people cancel, there's almost nothing left to refund. People buy insurance when times are good, and cancel when times are bad, the exact opposite of wealth building, and insurers profit from that. But are insurance companies invincible? Not exactly. The law of large numbers works until it doesn't. There are times when everyone faces risk together. Mass earthquakes, hurricanes, pandemics, wars. In those moments, insurance companies can go bankrupt because payouts skyrocket across millions at the same time. That's why reinsurers exist. Insurance companies that insure insurance companies. If one city is destroyed, the reinsurer pays the claims. These giants cover dozens of countries. So even if one nation suffers huge losses, other nations balance it out. And even if an insurance company itself fails, its policies are usually transferred to another insurer. So customers remain protected. So, should you even buy insurance? Insurance exists to remove catastrophic risk, the kind of event that can financially destroy you. It's like buying an airbag for your life, but judging whether the price is fair is nearly impossible for an individual. You could try buying the products where insurers lose money, like long-term care insurance or some ACA individual plans, but insurers just raise premiums the next year anyway. The better approach? Use insurance only for what can bankrupt you. Medical bills, cancer treatment, liability from car accidents, events that can ruin your life overnight. For everything else, instead of paying premiums, invest that money yourself over decades, exactly the way insurance companies do. Now that you understand how the system works, take a closer look before buying a policy. Ask yourself, where does my money go? Do I truly need this policy? Or am I paying for a risk I could handle myself?